Hello everyone, it is your friend here. For a long time now, we have been bracing for this financial conflict. We have meticulously scrutinized the CFTC data, pinpointed the exact moment JP Morgan shifted their stance, and kept a close eye on the growing scarcity in industrial supply. We are fully aware that a massive price surge is coming. The mathematical reality of the situation makes it unavoidable. However, today I must address the most significant risk in this entire scenario. It isn't Jamie Dimon or Jerome Powell that you should worry about. Rather, it is the person you see when you look in the mirror. Claiming victory in the heat of the battle is one thing, but successfully navigating the period of peace that follows is a different challenge entirely. Many of you have been diligently accumulating silver at price points like $20, $25, or $30. You have endured the intentional price smashes and maintained your positions despite the pressure. But have you dared to ask yourself the most chilling question of all? What is your plan once you actually win? What will you do when you wake up, open your phone, and discover that silver has skyrocketed to $100 and $150 or even $300? Most individuals assume they will feel nothing but joy, yet historical evidence demonstrates that the sudden creation of extreme wealth often sparks intense panic. This sensation is known as vertigo. When the digits on your account balance reach life-altering levels, your primitive lizard brain takes command. It begins to scream at you to sell everything immediately just to lock in the gains. This psychological reaction is precisely how the banking institutions intend to rob you of your prosperity a second time. They suppressed the price while it was low, and they will attempt to manipulate your emotions to get you to abandon your position as it climbs. We have to discuss the concept of anchor bias. Your mind is currently fixed on the idea that silver is a cheap commodity. You perceive $30 as a standard price and view $50 as an expensive peak, because that was the high point reached in 1980 and 2011. Consequently, if silver reaches $60, your brain will falsely signal that a bubble has formed and urge you to liquidate. In the world of finance, this is essentially a premature exit, and it represents the most catastrophic error you can make during a hyperinflationary currency reset. You must grasp that $50 is not the ceiling for this move, it is the new baseline. When we adjust for inflation using the more accurate 1980 CPI methodology, the true historical high for silver is actually closer to $600 or $800. If you decide to sell at $60, you are essentially trading your wealth for pocket change. You're giving your physical assets back to the very banks that are desperate to close out their short positions. The initial short squeeze is not the final destination. Consider the historical charts of GameStop or the famous Volkswagen short squeeze of 2008. The first major price jump is merely the shorts being forced to cover. The truly monumental move occurs when the available supply vanishes, nobody's willing to sell, and the price reaches astronomical levels just to entice a few people to let go of their metal. If you exchange your silver for $100 in paper currency, what have you truly accomplished? You have surrendered a rare, strategically important industrial resource in exchange for a depreciating debt instrument that is being printed in infinite quantities. You have essentially leaped out of a reliable lifeboat to climb back onto the sinking Titanic simply because the ship's buffet still looks appealing. Mastering the psychology of your exit is far more difficult than the entry. Buying an asset is the easy part. Selling it correctly requires perfect timing, immense bravery, and a pre-existing strategy. Without a plan set in stone before the price spikes, you will succumb to fear. You will either exit too early or stay far too long and ride the subsequent crash all the way back down. We should look back at the 1980 Hunt Brothers silver squeeze for guidance. During that period, silver rose from $6 to $50, but the journey was anything but a straight line. It was incredibly volatile and designed to shake out weak hands. There were specific days where the price plummeted by 20%. The individuals who panicked and sold during those temporary dips missed out on the final surge to the $50 mark. You must mentally prepare yourself for these volatility washouts. When silver hits a milestone like $75, the banks will likely trigger a massive sell-off to drive the price back down to $60. They want to set off your stop-loss orders and make you think the bull run is over. But if the underlying reality hasn't shifted, if the silver vaults are still depleted and industrial demand is still sky high, then that price drop is a bear trap. It is a calculated deception. You have to learn to distinguish between the market price and the actual value. The price is merely the number displayed on your screen, but the value is the utility and purchasing power the metal provides. During a total currency breakdown, the paper price can effectively go to infinity. Does this imply you should hold forever and never sell? No, it means you must change your point of reference. You should not be selling silver for dollars. You should be swapping silver for different types of assets. This is a vital distinction to make. If you sell for cash and let it sit in a bank account, inflation will consume your gains within 6 months. Your profit would be nothing more than an optical illusion. You would have a higher number of dollars, but you would be able to purchase fewer actual goods. This is the tragic fate of those who win during hyperinflation. They become millionaires in name only while remaining impoverished in terms of what they can actually buy. Your exit plan must be centered on the preservation of purchasing power. We are aiming to climb the hierarchy of assets. Our goal is to transition from a high volatility, speculative play, like a silver squeeze, into stable, wealth-generating assets like real estate, gold, or a private business. Do not let the illusion of dollar wealth cloud your judgment. Seeing $500,000 in your account will cause a massive dopamine rush, and you will start imagining what luxuries you can buy, like a Lamborghini or a boat. Stop right there. That is the mindset of someone who stays poor, and it is why most lottery winners eventually lose everything. We are focused on establishing dynastic wealth and a foundation that lasts for the next half century. The primary rule of a successful exit is to never liquidate your entire position all at once. This strategy is known as scaling out. For example, if you own 1,000 ounces and the price hits $100, you might sell 100 ounces to recoup your original capital. At that point, you are playing with house money. The fear evaporates and the stress of the trade disappears. If the price goes to zero, you haven't lost anything. But if it hits $500, you're still positioned to profit. But the real question is, what are you selling for? The most effective answer lies in the gold to silver ratio, GSR. This is the critical metric that professional investors track. They don't obsess over the dollar price. They watch the ratio because it indicates when silver is overvalued or undervalued compared to gold. At this moment, the ratio is sitting around 80.1, meaning it takes 80 ounces of silver to equal the value of 1 ounce of gold. This is an extremely high level historically, which tells us silver is currently very cheap. When the squeeze intensifies, silver will move much faster than gold, causing this ratio to collapse toward 61, 41, or even 31. When it reaches 31, silver is finally becoming expensive relative to gold. That is your true signal to act. Not a dollar amount, but a ratio target. That is the moment you perform a swap, trading your high volatility silver for the long-term stability of gold. In doing so, you are essentially using the silver price spike to acquire free gold. We will go into the specific details of how to execute this swap shortly, but for now, you must fortify your mind. The psychological pressure of a rising market is intense. You will witness your total net worth fluctuate by an amount equal to a full year's salary in just 24 hours. Do you have the stomach for that? Can you maintain your composure when you are up $50,000 at breakfast, but down $40,000 by dinner? If you cannot handle that volatility, you will make a critical error. You must detach your emotions from the fiat currency numbers. Remember, 1 ounce is 1 ounce until your specific goal is reached. The dollar price is just background noise. Your true objective is freedom and escaping the control of the current financial system. You don't escape that system by simply accumulating more of its tokens. Get your mind ready. Take a piece of paper and write down your exit strategy right now. Write, I will sell 10% of my stack at 100. I will swap 20% for gold when the ratio hits. 40. 1. Create this contract with yourself while you're still thinking rationally. Once the mania begins, and everyone from your Uber driver to your grandmother is talking about silver, you will no longer be rational. You will be driven by emotion, and the markets always punish emotional participants. We have already established that selling for paper currency is a trap. If the dollar is losing its value, why would you want to hold more of it? Your goal is to obtain superior money, and the only money that surpasses silver is gold. Welcome to the world of the ratio trade. This is the hidden strategy used by those building lasting dynasties. This is how you transform a silver collection into a massive treasury of gold without spending any additional out-of-pocket cash. Let's look at the statistics. Right now, the gold to silver ratio is roughly 80 to 1. This means trading 80 ounces of silver gets you 1 ounce of gold. Historically, this is an extreme outlier. The geological ratio of how these metals are found in the earth is about 8 to 1. The historical monetary ratio used by the Roman Empire and mentioned in the U.S. Constitution was roughly 15 to 1. The modern average is usually between 40 and 50 to 1. When the silver squeeze happens, silver always outperforms gold because it is a much smaller, more volatile market. While gold might double in price from $2,500 to $5,000, silver could potentially quintuple from $30 to $150. When this occurs, the ratio will plummet. Why make the move to gold? Because following a massive speculative peak, silver almost always experiences a sharp correction. It is often called the devil's metal because of its violent ups and downs. Gold, by contrast, is God's money. It is stable and maintains its value over the long haul. By switching to gold near the peak of the silver frenzy, you are securing your purchasing power in a much more resilient asset. You're stepping away from the chaos while remaining within the safety of hard assets. This approach requires immense patience. You have to monitor the ratio constantly. Set your targets. Target 1 is a 50.1 ratio, where you swap 20% of your silver. Target 2 is 30.1, where you swap another 30%. Target 3 is 15.1, where you might swap the remainder or keep a small core position. If we ever see the 15:1 ratio again, which happened briefly in 1980 and 2011, your 1,000 ounces of silver would buy a staggering 66 ounces of gold. That is a life-altering amount of wealth. Imagine having 66 ounces of gold as your retirement fund, all starting from a silver stack that originally cost you $30,000. In certain areas, this trade even offers tax benefits. You should consult a tax expert, as I am just an observer on the internet. But in many places, a like-kind exchange or swapping one type of bullion for another is treated more favorably than selling for cash. Even if you have to pay capital gains tax, paying it to acquire gold is far better than holding a currency that is losing 20% of its value to inflation every year. How do you actually do this? You contact your local coin dealer or your preferred online bullion shop. You tell them you want to trade your silver eagles for gold buffaloes. They perform these trades every day. While they will charge a small fee or spread, that cost becomes insignificant compared to the wealth gained from a collapsing ratio. However, there is a catch. You must get over your emotional attachment to your silver. We all love the feel, the weight, and the fight the system narrative associated with silver. But you cannot afford to fall in love with an investment. Silver is the vehicle. Gold is the final destination. Silver is the rocket ship that breaks you out of the atmosphere, while gold is the stable space station where you can live securely. You also need to consider where the big money is going. Central banks are loading up on gold, not silver. When the global monetary system is eventually reset, it will almost certainly revolve around gold. By moving into gold, you are aligning yourself with the world's most powerful financial insiders. You are getting ahead of the eventual remonetization of gold reserves. This strategy also resolves the issue of physical storage. If silver reaches $100, your stack will be worth a lot, but it will be incredibly heavy. 1,000 ounces of silver weighs about 68 pounds. It is bulky and difficult to move in an emergency. If you swap that for 33 ounces of gold, you can carry your entire net worth in your pocket. In a world of geopolitical chaos, being able to easily transport your wealth is a major advantage. You can run with gold, but you cannot easily run with a heavy monster box of silver. The ratio trade is the sophisticated way to exit. You won't have to stress about the dollar's value or the safety of the banks. You're simply moving from an undervalued asset, silver, to a fairly valued one, gold, once the gap has closed. Historically, the ratio has a tendency to overshoot its targets. It could drop to 10.1 or even lower during an extreme industrial shortage. However, you shouldn't get too greedy. As the saying goes, bulls make money, bears make money, but pigs get slaughtered. A target of 30.1 is excellent, and 20.1 is a dream scenario. If you can capture any part of that movement, you have already won. Always remember that the goal is not to accumulate more paper dollars. It is to maximize the total ounces of precious metal you own. If you begin with 1,000 ounces of silver and end up with 60 ounces of gold, you have performed a kind of financial alchemy. You have created massive wealth simply by playing the ratio. This is exactly what the wealthy do. They don't just sell assets, they rotate them. When real estate is high, they sell and buy art. When art is high, they buy bonds. When bonds fail, they buy commodities. You are performing that same rotation on a smaller scale. When silver hits $100, look at the gold price. If gold is still at $2,000, the ratio is 20.1, which is a massive signal to buy gold. If gold has also risen to $10,000, the ratio is 100.1, and you should keep your silver. Let the math make the choice, not your feelings. This strategy requires you to be completely objective. You are betraying your silver stack to move into gold, but in finance, your only loyalty should be to your family's future, not a specific metal. While gold is perfect for preservation, what if you desire cash flow? What if you want to build a real estate empire or own the land itself? This leads us to the second pillar of the exit strategy, swapping your metals for real estate and other hard assets. The cycle of wealth typically moves from paper to commodities, then to real estate, and finally to businesses. We are currently in the commodity phase. Silver is rising, but eventually the cycle will turn. Typically, when commodity prices peak, interest rates are forced higher, which often causes the economy to stumble and the real estate market to crash. We are heading toward a perfect storm, where silver might hit its all-time high at the exact moment the housing bubble bursts. This represents the opportunity of a lifetime, the chance to trade an asset that is at a peak for one that is at a bottom. Imagine it is the year 2026. Silver is $150, and your stack is worth a fortune. Meanwhile, mortgage rates have climbed to 12%. People are defaulting on loans, and home prices have plunged 40%. Commercial buildings are sitting vacant, and the market is in shambles. That is the moment you act. You take your silver or the gold you swapped it for, and you purchase income-generating assets. You buy rental homes, farmland, or a business that produces steady cash. Silver and gold are great insurance, but they don't pay you a monthly dividend. Land, tenants, and crops do. The true end goal of financial freedom is passive income, and you can use your silver profits to buy the engine that generates that income. However, you must be extremely cautious. Do not think of real estate in terms of dollars. Instead, look at the price in terms of ounces of silver. If an average house costs $400,000 today and silver is $30, that house costs 13,133 ounces. In the event of a reset, if the house price drops to $300,000 and silver rises to $150, that same house now only costs 2,000 ounces of silver. You would be acquiring that house at an 85% discount relative to your silver holdings. This is how the truly wealthy acquire assets. They price everything in gold and silver. When the silver price of a house hits a historical low, you buy. I also have a word of caution regarding debt. Many people ask if they should use their silver profits to pay off their mortgage. The answer depends on your situation. If you have a 30-year fixed-rate mortgage at 3%, you should not pay it off. In that scenario, inflation is actually helping you. The bank is losing value on that loan, and you're paying them back with cheaper, inflated dollars. Let inflation erode the debt for you. However, if you have any variable rate debt, credit card balances, or high-interest loans, you should eliminate them immediately. Use your profits to become completely debt-free. Real freedom is the peace of mind that comes from knowing no bank can ever take your property. Being debt-free gives you the ultimate power to say no. We also need to discuss lifestyle creep. When you finally cash out at $100, the urge to buy luxury items will be incredibly strong. A new truck, a boat, or an expensive watch. Remember that these are depreciating assets that eventually go to zero, while silver has the potential to go much higher. If you trade an appreciating asset for a depreciating one, you are destroying your long-term wealth. Only buy the toys if the cash flow from your new income-producing assets can pay for them. Use silver to buy a rental property, and then use the rent from that property to buy your truck. Never consume your seed corn. Farmland is an especially attractive option. In a world with resource shortages and failing supply chains, owning productive land with water rights is the ultimate form of security. If you can trade your silver for 50 acres of good soil, you have ensured the survival and prosperity of your descendants. You are trading a symbol of wealth, silver, for the reality of wealth, food and water. This is the barter economy mindset. When a currency collapses, money fails, but trade continues. You might find yourself trading 100 ounces of silver for a tractor or 500 ounces for a plot of land directly, bypassing the banks entirely. The major banks know this, which is why they are currently buying up as much land as possible. They want to be your landlord. The silver squeeze gives you the chance to escape their system and become the owner of your own domain. The timing of this swap is difficult because real estate moves much slower than the silver market. Silver might peak and then drop before the housing market reaches its absolute bottom. This is why a bridge strategy, moving from silver to gold and then eventually to real estate, is often the best path. Step 1, ride the silver squeeze. Step 2, swap to gold to lock in the gains and lower your risk. Step 3, wait a year or two for the real estate market to bottom out. Step 4, trade your gold for land. This requires immense discipline. It means holding gold while everyone else is chasing the latest stock or crypto trend. It means being a contrarian twice. Once when you bought silver and again when you buy real estate. But the reward is generational sovereignty. You become the ancestor who secured the family legacy, which is worth far more than any luxury car. So start doing your homework now. Research the price of land or a duplex in your area and calculate it in ounces of silver. If a duplex costs 10,000 ounces now, watch for that number to drop. When it hits 2,000 ounces, make your move. An exit strategy isn't about leaving the market. It's about moving your capital into the next undervalued sector. It's like a game of musical chairs, and you want to be the one holding the most solid asset when the music finally stops. Finally, we have to talk about the most difficult part. How do you identify the top? How do you know if $100 is the peak or if it's heading to $500? No one can time the absolute top perfectly, but you can identify a mania phase by looking for specific signals. The first indicator is a shift in the mainstream media. For years, major outlets like CNBC and the Wall Street Journal have ignored silver or mocked it. They didn't want you to own it. But when you turn on the news and see pundits screaming at you to buy silver, or when you see a silver bar on the cover of Time magazine, that is the signal that the top is near. When the establishment finally gets on board, it usually means the insiders are looking for retail buyers so they can exit their own positions. The second signal is the taxi driver indicator. When people who have no background in finance, your barber, your dentist, or your cousin, start giving you tips on silver, the end is close. When the general public joins a speculative frenzy, the smart money is already leaving. If your grandmother asks how to buy a silver ETF, it might be time to sell. The third signal is parabolic exhaustion. A healthy market moves up in steps, consolidating along the way. A mania looks like an Eiffel Tower. It goes straight up at a 90-degree angle. If you see the price double in a single week, be very careful. That kind of growth is unsustainable and indicates a blow off top. The crash on the other side will be just as violent as the rise. Be on the lookout for the bull trap. After the first major crash from the peak, the price will often bounce back strongly. Everyone will claim it or as of buying opportunity, and that the price is headed to new highs. But if the underlying fundamentals have changed, if the shortage has been resolved or the ratios have flipped, that bounce is a trap designed to create bag holders. Look at the commercial short positions again. If JP Morgan suddenly goes heavily short at $100, you should pay attention. Do what the banks do, not what they tell you to do. Keep an eye on the CFTC reports and the physical premiums. During the squeeze, the premium for physical metal will be huge. But at the peak, premiums often disappear because so many people are trying to sell their metal back to the dealers. When there is a line out the door of people selling, and the dealers stop buying because they have too much stock, the top is in. You will have to fight your own greed at the peak. You will feel like a financial genius and believe the price will never stop rising. You'll start thinking that another $50 in price will make you a billionaire. That greed is your greatest enemy. Stick to your written plan. If your plan says to sell at a 31 ratio, do it. Don't try to time the exact dollar peak. The person who sells a bit early is the one who actually keeps their profit. If you sell at $90 and it goes to $100, you are still wealthy. But if you wait for $110 and it drops back to $50, you have failed. Leave that last bit of profit for someone else. Think about regret minimization. Which would you regret more, selling at $100 and missing a move to $150, or not selling at $100 and watching it crash back to $30? The second scenario is a disaster, while the first is just a missed opportunity. Protect yourself from the disaster at all costs. Always remember the reason you started stacking in the first place. You didn't do this to get a high score on a screen. You did it for freedom. You did it to protect your family from currency debasement and a failing system. If selling your silver allows you to own your home outright, buy a farm, and put some gold in your safe, then you have won the game. You have achieved your goal. Don't get caught up in the gambling aspect. Take your winnings and walk away. We are entering uncharted territory. The $100 mark is a massive psychological and financial hurdle. Beyond that point, the world will be full of extreme opportunity and extreme danger. Your exit strategy is your survival gear. Put it on now. Don't trade for paper money unless you have high-interest debt to pay off. Swap for gold when the ratio hits your targets, and swap for land when the real estate market falters. This is how we achieve true victory, not just by being right about the price, but by being smart with the wealth we've built. We are the stackers. We have been patient and relentless. We survived the years of price suppression, and now we must survive the victory. I am your friend here. Write down your plan, verify your inventory, and I will see you on the other side of $100. Don't forget to hit that subscribe button so you won't miss out on the next update.